All right. Hello, everyone. Welcome back to our classroom today. We're going to go today's section as we'll finish off the option section today. So last time we talked about the option fundamentals, right? What they are as contracts between investors that effectively locks in the price for a certain period of time. Okay. Call options give you the right to buy 100 shares of stock at the strike price, a pre-agreed price, and a put option gives your holder the right to sell 100 shares of stock at a fixed pre-agreed price. We also talked about using options as a hedge strategy. That's where someone has a position in the underlying stock and then they buy an option to go with it. The reason they buy the option this time, not because they think the stock's going to go a certain direction, but in case it goes in a certain direction, in case it goes in the wrong direction, wrong from their point of view. Now in this case, we're going to talk about using options for income. And see, instead of buying options and paying premiums, we can sell options and collect premiums. So it's an option income strategy. Okay, so it's a very popular strategy is known as covered call writing. A lot of people do this. This is where someone owns the stock and then they sell a call option. So long stock means they own it and they short the call or they sell the call option, selling someone else a call option, selling someone the right to buy their stock from them at a fixed price, at the strike price. They're getting paid to pre-agree to sell the stock that they own at a fixed price. Okay. So this provides income to them because when they sell the call option, they receive that cash premium. That is cash in pocket when someone sells a call option. Okay. Now, people might use a covered call strategy when they expect a flat market, or at least for the time being. They still own the stock, and they still, of course, looking for the stock to rise in price. But maybe for the moment, they kind of expect it to be pretty flat, not go much anywhere. Well, if the stock isn't really doing anything and it's not going anywhere, you're not really making any money off of this. It's kind of like, it's not really investing for you. So what they can do is sell the call option and collect that income from the premium to turn this into an asset that now is producing some income from it. So the idea is, if the market remains flat, someone won't sell it. They're selling someone else the right to buy their stock from them. Now, of course, if the stock doesn't go up, right, it stays the same, the option will expire. Now, the option expires. They didn't have to live up to the contract. They didn't have to sell their stock to anybody. So they still own their stock and they're still holding on to the cash, still holding on to that cash premium. Now, of course, they wouldn't want to do this in a bearish market if they expect the stock to go down. If they did, they'd probably just want to get rid of the stock. But if the market falls, the stock, this call expires. No one buys the stock from them, but they still have that cash premium, which does at least a little bit offset their losses, just at least some degree. So a covered call gives a partial hedge, a little bit of downside protection. Now, however, if the market does go up, well, they've already agreed that they'd sell their stock to somebody at a fixed price. Right? And whoever that is going to say, I'm going to use my call option and buy the stock from you at the price we agreed. So here's the thing. Once the stock goes above that strike price, they've already agreed they'd let it go for that price. So if it keeps going up and up after that, they don't get to participate. So what it does, it gives them a little downside protection, provides some income, which can help increase their return on their investments, but it also limits their upside potential, their potential gain. All right, so let's take a look at some examples here. So here we go. The customer buys 100 shares of ABC at $50 and then sells or writes one ABC 60 call at 5. So let's look at what was this: max gain, max loss, break even, or profit or loss scenario. Like I said, those are the kinds of questions they can ask you. By the way, Jenny, I hope I answered your question before. If you said it was long instead of short, okay, right? It would have been a in the money option. Only problem was it wasn't in the money by enough. Didn't cover all the costs. It would have made $3 on the stock, but it cost $7 for the option. Not enough. It wasn't profitable enough. Did that help, Jenny? Let me know if it didn't. Okay. Okay. All right. Let's check this out and see what the results are here. So customer buys ABC at 50. So since we're buying something, we're going to make a note of that on the money out column. Buy ABC for minus 50. Then the person sells the January 60 call. So we're going to do this. So our next transaction is sell the call and collect $5 in premium. Now, at this moment, what's their cash position now? If 50 went out but 5 came in, how much are they? How much is this person out of pocket right now? Right. 45. Karina, Amy, Ashley, Alexis, Alicia. Good. You're $45 out of pocket right now. So what's the break even point? If he's right, if he's out of pocket 45 and he sells it, how much you got to sell it for just to break even? You got 45, because if he did in fact sell ABC for $45, then 50 went out, 50 came in. So here's the thing. So the break even is 45. So the stock he bought at $50, it could still fall down to 45 and he hasn't lost money. That's why I call it a partial hedge, some downside protection. Right? If he needs full protection, then you got to buy the put option, right? You got to buy insurance to have full protection. But it gives him a little downside protection. Okay. What's the maximum loss in this scenario? Let's look at it this way. What's the maximum loss in this trade? What's the worst thing that could possibly happen to him now having sold this call option? Right, and bought ABC stock. What's the absolute worst possible thing that could possibly happen now? Minus 1600. Okay, minus 1600. All right, let's check this out. The worst thing that could possibly happen now: ABC is bankrupt and the stock is worthless, and he sells ABC stock for nothing. Okay, absolute worst thing could happen. So if that's the case, 50 went out, 5 came in. Right? So we will have a grand total here. Actually, I should put it over here. A grand total of minus 45 times 100 shares, minus 4,500. So maximum loss would be 4,500. Now, by selling this call option, it did slightly soften the impact of a worst case scenario. If he bought the stock at 50 and didn't sell the call, he would have lost $5,000. Now he just loses 4,500. I'm sure that's small comfort, I'm sure. Okay. But even so, it's there. Okay, now what's the maximum possible gain on this transaction? Well, of course, he'll gain if the ABC stock goes up, right? And is there a limit or a ceiling how private price stock can go up? So what's the maximum gain on this transaction? Okay, unlimited. Unlimited, maximum possible gain. Okay, right. There's no ceiling how high price ABC stock can go. It can go up to 100, 1,000, 10,000, right? Except for one thing. He sold the ABC 60 call. What's going to happen if ABC is above $60 by January? Going to get called, right? Which means our customer here is going to be required to do what? Going to have to sell, and sell at what price? At the strike price of $60, exactly. So once it goes above 60, he's basically agreeing to let it go for 60 and caps off his profit here. So we see that 50 went out and 65 came in. What's our grand total? Would the max be with the premium received? No, first off, no, the max is more than that, isn't it? More than the premium received. The premium, that will be part of it, but check it out. 50 went out and 65 came in. So how much did he make on this transaction? All told. Mhm. Right, Alexis? Plus 15 times 100 shares. Plus 1,500. Right. But that's the maximum gain now because by selling the call option, he agreed he'd let it go for $60. Would have made bought it for 50, sold it for 60, plus collected another $5 for the option itself, plus 15, which isn't bad, of course. Not by any means. Okay. Someone once asked me once, okay, she did her very first covered call. It was like on Intel stock. And she said, what's the worst thing that could happen? Well, as I said, the worst thing that'll happen is Intel goes bankrupt and your stock is worthless, but you still got the premium from selling that call option. So, like I said, slightly soften the impact of a worst case scenario. The second worst thing that can happen to you is Intel shoots up to $5,000 a share and you agree you let it go for 60. That's the second worst thing that could happen to you. Okay. But hey, it's still a profit. It's still a profit though, right? Okay. And does it happen all that often that a stock shoots above, right? Goes from 50 to $60 like that? It does happen, but not all that often. So anyway, that's a way you can do it. That's a way of okay. So this is an income producing strategy. So what's the gain or loss if the market goes to $66? Well, it would be the same because once it's above 60, right, the call holder is going to exercise the call and says, I'm going to buy it from you at $60 like we agreed. So our customer has to sell it to them at 60. Okay. All right. So that is an example here. This is covered call writing. Now, the idea here is, okay, the idea is that they figure that ABC is still going to be below $60 by January. Okay. So if that's the case, the call option is not going to be assigned, is it? Okay? And it's not going to have to live up to the contract. So he sold the January call for $5. January comes and goes. ABC is still below $60, so the holder wouldn't exercise the call. So the call expires, right? So this obligation, this contract is gone, right? No longer has this obligation, but still has his ABC stock and still has the premium collected too. So how about if you do it again? Sell the February call, collect another premium, let it expire. Sell the March call, collect another premium, let it expire, and so on and so on. Okay. And I have people who do that, right? They just keep collecting premiums off the stock they own and just turn this into this cash flow machine. That's absolutely possible to do. And there are people who do it. All right. Are you good? Okay. Any questions? Is there any part of this that's not totally 100% there? Okay. Good. 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 Okay. All right. All right. Thanks, Karina. All right. Covered put writing. Now this doesn't show up a whole lot in reality. Covered call writing is very popular. There is a thing called covered put writing. I worked as a rep for 8.5 years. I don't think I remember seeing anybody do a covered put writing even once. I don't think anybody even asked me about it. Nevertheless, it is there. And it is also a way to collect income. When someone sells a stock short in a short sale, that means they sold something they don't have, right? By arranging to borrow shares of stock from their broker dealer. Maybe they borrowed 100 shares of ABC and sold the shares and got the money deposited in their account. Now they can't take the money out, can't spend it because they have this liability. They owe their broker dealer 100 shares of ABC. Okay, they're coming up short by that. But at some point, the plan is wait for the stock to fall in price, and then what does buy it later when it's cheaper. Use what they bought to replace what they borrowed, so they don't owe anything anymore, no more obligation, but they get to pocket the difference. That's the idea. Now, they're going to buy the stock eventually anyway. If they sell a put option, they're giving someone else the right to sell their stock to them at a fixed price. They're getting paid to agree to buy the stock from someone else at a fixed price, and that's the whole plan. And again, they plan to do this if they expect the market to remain flat for a while and it's not performing for them. Remember, they profit if the stock goes down, but if it's not going down, it's not performing. So sell a put option and collect some premium in the meanwhile. So at least it's doing something for you. Okay. If the market goes up or the stock goes up, well, then they're going to have to, well, they'll okay, the put will expire. But if the market falls, they're going to be assigned the put option. I'm going to sell my stock to you at this price, and they've agreed they'd buy it from them at the pre-agreed price. But if it keeps going down below that, like I said, they get some income. It helps reduce their risk a little bit with getting some cash flow. That can also enhance their rate of return, but it also limits their potential profit. That's the trade-off. In our example, a customer shorts or sells short 100 shares of ABC at 50, and then sells or writes or is short one ABC January 45 put at 3. All right, so let's help fill out the T-chart here. What's our first step? What's the first thing we do? Borrow the shares. Okay, it's true. The first thing they do. Now that we borrow the shares, then what do we do? Sell them, right? Okay. Okay. So is it okay? Is it out 50? If you're selling something, is that money out or money in? Okay. It's in. It's in 50. Yes. Right. So we're going to sell ABC. Oops, it says black. Let's see if I can fix that. Oh, okay. Oh, sorry. I know why. Hold on. That's because I did a text box rather than this. I'll just type in this in the thing here. Okay. If I just type in this, okay. Sell ABC plus 50. Yeah, in, right? Okay. What's the second step? Buy the stock at 5 or 45? No, not yet. Not yet. What do they got to do first? What's next on our list of activities here? Now we're not ready to buy the stock yet because we sold the put. Yes, Amy. Yes. Okay. We sold the put for $3. So since we're selling something, we're going to put that on the money in column 2. Sell put plus 3. At this moment, they're up by $53 a share. Okay, $53 in pocket at this moment. Now, again, he's got to buy the stock back again sooner or later, right? So what price will he have to pay for ABC stock just to break even? 53. So if he buys it for $53, a total of 53 came in, 53 went out, grand total was 0. So again, this gave him some protection because remember, as a short sale, he makes money if it goes down, but loses if it goes up. So the stock he sold short for 50, it could still go up to 53 and he still hasn't lost money. Once it's above 53, he's going to start to lose because now he's got to replace what he borrowed but at higher prices rather than at lower prices. And yes, if it keeps going up and up and up, okay, he's going to lose more money. But okay, good. So our break even is 53. Okay. Well, in that case, if it keeps going, once it goes past the break even point, he's going to lose more money. What is the maximum possible loss on this transaction? $5,300. Now remember, he loses money if it goes up, right? And if it keeps going up, he's going to lose more and more money, right? Yeah, unlimited, right? Because if he could buy, right, if it keeps going higher and higher, and there's no ceiling, he may have to pay an unlimited amount to buy that stock back. Now, okay, in reality, by the way, broker dealer firms aren't going to let that happen. If they see it going the wrong way, they'll force a buy-in. But for now, okay, it's potentially unlimited. Well, if infinity goes out and $53 comes in, what's the maximum possible loss? Unlimited. All right. What's the maximum possible gain on this transaction? Now, again, he's going to make, as a short seller, profit if the stock goes down. How far can the price of a stock go down? Okay, the question is, why is it unlimited? Why is it unlimited? All right, instead of 5,300. So 5,300 came in, that's true. But remember, he's got this liability, right? He owes his broker dealer 100 shares of ABC, and he's got to replace what he's borrowed eventually. Now, if ABC goes up instead of down, once it's above 53, he's going to start losing money, right? What if he buys it back at 54, for example? Well, 54 went out and 53 came in. He loses $1, right? $1 per share. And if it goes to 55, he's going to lose $2 a share. But if it keeps going up and up and up, okay, if it goes to $1 million, right, he's going to lose a lot of money, isn't he? So therefore, right, his loss is theoretically unlimited because he may have to pay some infinite amount to cover it. Okay, thanks, Serena. Okay, but what about on the way down? Okay, because he'll make money on the way down if it becomes cheaper and he can replace what he borrowed at lower prices. How far can it go down? Okay, so a couple of said it could go down as far as 0. Right? So could he buy it if the company is worthless? Can he buy it for nothing and sell it for 50 and then buy it back for nothing? Okay. Well, that's the thing though. He sold the ABC January 45 put. So what's going to happen if ABC goes below 45? As an option seller, he has an obligation. What's he obliged to do? To exercise? It's the holder who exercises. The person who bought it from him, that's who exercises the option. And if ABC goes down below 45, well, someone's going to definitely exercise the option. He's going to say, I'm going to exercise my put option and sell ABC stock to you at $45 like we agreed. So therefore, I'm going to sell it to you at 45. So what's our customer got to do? No, the customer isn't going to sell it. It's the person they gave it to who's going to sell it, which means our customer has to. I'm going to sell it to you at $45. What are you going to do? You're going to buy it. Yes. You're going to buy ABC at what price? At 45. So on our grand total here, 45 went out and 53 came in for a grand total of plus 8 times 100 plus 800. That will be their maximum possible gain because he's already agreed he'd buy it back at $45 no matter what the price is. So if it goes below 45, he's basically capped off at 45. Max gain is 800. And it's like, okay, then it says, well, what happens if the market goes to 43? Again, if the market goes to 43, he's already pre-agreed. He's contracted to buy it back at 45. So he'll have to buy it back at 45. Okay. Is this helpful? Is this good? What if I said the market went to 47 instead, and then the customer will close out his short position? So in that case, instead of he's going to buy it at what price now? Is he going to first off? Is he going to be assigned the put option? Is someone going to say I'm going to sell it to you for $45 if it's worth 47? Doubt it, right? Okay. So in this case, he's going to buy at the market price of 47. 47 went out and 53 came in. So his total is plus 6, right? Or a $600 profit. Okay. That'll be the way it would work. Okay. So these are income strategies. You can identify that. Okay. Remember, in a hedging strategy, you identify that because they have a position in the stock and then they buy an option to go with it. And the option they buy is the opposite strategy of the stock that they own or the stock position. If they own the stock, they buy a put. They're bullish on the stock, but the put is bearish, okay, in case the opposite happens. If they sold the stock short, which means they're bearish on the stock, they buy the call, which is bullish, just in case the stock goes up instead of down. You can identify an income strategy when someone has a position in the stock and then they sell or write an option to go with it. And the reason they're selling it is to collect some income, collect some cash flow, reduce their out-of-pocket expenses, or reduce their risk a little bit, plus receive some cash flow can help enhance returns. Okay, good. Now with our next section here, let's talk a little bit about index options. Now this is not going to be as heavily tested. I expect most of your questions, in fact, maybe even all the questions you see about options, are going to be on equity options. The word equity means ownership, and ownership means stocks, right? So an equity option is the right to trade 100 shares of stock at a fixed price. But we can also, people get options on a market index. Now an index is a way of measuring the overall stock market or a segment of it by using a representative sampling and use that as a barometer of the overall market. When the test talks about a market index, for the most part, it's talking about the Standard & Poor's 500. Okay, so Standard & Poor's is a research company, tracks the price and performance of 500 of the biggest, most widely held U.S. companies, and uses that as a measure, a barometer of the overall stock market. How did the stock market do today? You hear it on the nightly news? Well, the S&P 500 was up or down or whatever. Okay, so rather than buying just an individual option or on individual stock, they can make bets basically on the overall market. Okay, so they're index options, and there are various indexes that they can trade. Now, the very first index option that was created was based on the S&P, the Standard & Poor's 100. Now, the S&P 100, like you might imagine, is a subset of the S&P 500, 1/5 the number of shares. And its ticker symbol is still is OEX. All right, so if you see an OEX, that's the ticker symbol for the S&P 100. So how's the market doing? So they might be on the S&P 100, and they could trade options on that. Making a bet, they could buy call options on the OEX if they think the market's going to go up. They can buy put options on the OX if they think it's going to go down. Or they can use them as a hedge. Someone owns a shares, let's say some mutual funds. How can they protect their mutual funds if the market goes down? They can hedge by buying an index put option, because put options become more valuable if the market goes down. So while their mutual funds go down, their put option goes up, and so to some degree can offset their losses. Now, options can be exercised in one of two styles: American style options, which can be exercised at any time up until expiration, or European style options, which can only be exercised on their expiration date and at no other time. So if it helps you remember this, think of the letter A in American to also mean the letter A in any time. European style options, think of the letter E in European to also mean the letter E in expiration. Okay, good. Now, when you're trading the index option, when you buy or sell it, just like the is for equity options, the trading the option is a one business day settlement, right? Money and the option contract changes hands the next day. But what happens when an index option is exercised? Okay, and someone says, I'm going to buy the index from you, or I'm going to sell the index to you. Well, an index is just a mathematical construction. So, and you couldn't really deliver one share of 500 different companies or 100 different companies. Okay, so instead they settle in cash. Right? It's just the cash difference between the level of the index and the strike price of the option. So if the option is in the money, the option writer, right, who sold the option, is going to pay the option buyer the in the money amount within one business day. Okay, let's do a little illustration here. Let me see if they have an illustration. All right, they don't have one. So let me make one up. All right, so let's say someone owns or buys one OEX 550 call at, I don't know, 5. Okay, and let's say I'll just say it's November call. Okay, in November, the OEX is at 560. Is this option in the money? If you can buy something for 550 and it's worth 560, option's in the money. So the option holder is going to say, I'm going to buy the OEX from you at 550. Okay, it's worth 560. So what's going to happen is that's a 10-point difference, right? 10 points. And every point is equal to, right, is multiplied by 100. So therefore, the option buyer, the option writer rather, pays the option buyer $1,000. 10 points at $100 per point, $1,000. So that's what they mean by a cash settlement. They don't trade the index itself because it's just a mathematical construction. So they basically face the cash difference. Had the option been out of the money, had it been 540, well then the option buyer the option is just going to expire out of the money. That option seller gets to keep the difference. Okay, good. All right. So that's an index option. There are also options on foreign currencies. Now, foreign currency. Now, the currency, because after all, currencies, right, the exchange rate goes up and down too, and people might want to lock their exchange rate relative to the US dollar against British pounds, Canadian dollars, euros, what else do they have? Swiss francs, so a Japanese yen. Okay. So we can use options on currencies, one of which is just to, again, speculate. Speculate is a nice way of saying gamble. Okay. But if someone thinks that the exchange rate between the US dollar and the Japanese yen might go a certain way, they can make a bet on it by buying call or put options. Or they can use it to hedge their investments too, right? Especially like import export. A customer has to pay a bill in Japanese yen in 6 months, right? Maybe they bought some, I don't know, some Japanese stereos or something. Okay. So, well, what happens if the yen increases in value? If that's the case, he's got to come up with more dollars to buy the same amount of yen. So in that case, we want to lock his price on yen now by buying a call option on the yen. So just in case it does go up, he can use the call option to protect, right? Okay, lock in a buy price on Japanese yen. All right, again, to tell you that no options are on the US dollar. So therefore, they have to be done always in foreign currencies. So what happens if someone is like the Japanese companies who's going to get paid in US dollars? And what if the US dollar goes up in value relative to the yen and they don't get as many yen for the same amount of dollar? They would also buy put options on yen because they get the dollars and they can then sell or exchange it for yen at a fixed rate just in case it goes down too much. Again, I do not expect many questions on index or currency options. I would expect more questions, of course, on about equity options on trading 100 shares of stock. Okay. Well, right now we're at the top of the hour and probably a good fine time to take a break. And I've got 1 minute past, so return at 11 past the hour. And of course, as always, if you want me to go back to another slide or if you have another question or some clarity you need, please feel free to unmute and ask a question or type it into the chat and I'll reply to you accordingly. And I'll see you in a few. All right, so let's go ahead and pick out one of these Kahoots here. And we'll start here with this one. And all right, so let's go to kahoot.it and enter your PIN 377645. All right, good. Okay, 5 so far. Okay, good, Joe. Okay, good. Colby, thanks. All right, waiting for a couple others to join us here. Okay, thanks, Kimberly. Let's see, we're looking for Amy and Janae. Are you going to have a chance to join us? Oh, not logging in. Okay, gotcha. Okay, well, Amy, will you have a chance to join us? Okay. Amy, are you able to log in, or would you prefer to sit this one out, or experiencing technical difficulties? Okay, because we've got to move on. We've got to make sure we get done on time today. So, Amy, if you're able to join us, now would be a good time. If not, please let me know so I'll know. Okay, thanks, Amy. Okay, Amy's thumbs up. Okay, so wait for you to join us here.
Sorry about that.
Okay, no worries. Did we just lose somebody? Okay, Alicia's here, back again. Okay. Amy, okay. All right, okay, are we ready to go? Then let's play Family Feud. Okay. Which of the following would a registered representative be able to make for a customer in a non-discretionary account? 1, the time of execution of the trade. 2, which security to buy. 3, how much of the security to buy. 4, at what price to execute the trade. Right. Is the best answer A, 1 and 4, B, 2 and 4, C, 2 and 3, or D, 1 and 2? In a non-discretionary account. All right, some difference of opinion here, but this being a non-discretionary account. Remember, a discretionary account is one where the customer has allowed the reg rep to make trading decisions for the customer, basically even deciding what or when to buy or how much to buy or sell. Customer just saying, take care of business, do what you need to do. Okay, so if the customer allows the rep to choose which security to buy or how much of it to buy, that would be a discretionary account. But however, if the customer lets their rep choose the time or price of the trade, that is not considered discretionary. Right? They'll let their rep use their judgment when they think the price is right. Okay, like buy 100 shares of Nike if you see the stock go down. Okay, yeah, they'll let the rep use their judgment when they think the price is right. So therefore, our best answer choice is indeed 1 and 4. Okay. Now again, please, if you need any extra detail about that, please feel free to unmute or ask questions. All right, and Alexis and Colby are up on the board. Very nicely done. Okay, so what's our next question? An opening transaction can be A, a buy only, B, either a buy or sell, C, a short sale only, or D, a sell only. Either a buy or sell. Exactly. An opening transaction, right, is just when someone creates a new transaction, right? They start a new trade in their account or a new item in their portfolio. Their opening trade can be a buy, right? If you buy something, but remember when someone sells a stock short or writes an option contract, their first transaction is to sell something, which would be an opening sale. Good. So it can be either a buy or a sell. Perfect. Okay. Well, a bunch of scores on the board now. Let's check our next question. Mr. Smith has owned XYZ stock for years and wants to take his profit and invest that money in another stock. He should A. Sell XYZ to open. B. Sell XYZ to close. C. Buy XYZ to open. D. Buy XYZ to close. Since he already owns the stock, right, he want to get out of it by selling the stock. But since he already owns it, he's getting out of the transaction, right, out of his position, out of his investment. That would be a closing transaction. He already bought to open years ago. Now he's going to sell to close. Okay, again, if that does make sense, if it were a short sale, remember selling a short, that's an opening sale. Selling a stock short, selling something you don't have, borrowing the shares and arranging and selling. That's an opening sale. Okay, Amy's moved up big time, and Alexis a streak of 3. Next question. A person who is vested with legal rights and powers to be exercised for the benefit of another is known as A, a sponsor, B, a dealer, C, a fiduciary, or D, a broker. Okay, good. Legal rights to exercise benefit for another is known as a fiduciary, right? As a fiduciary has to manage someone else's assets, right? As in a way that is to always put that other person's interest ahead of their own at all times. So a investment advisor is a fiduciary, a trustee of a trust is a fiduciary, a custodian for a minor's accounts, these are fiduciaries. A sponsor, the only time I ever see the term sponsor is in mutual funds. The sponsor is also known as a distributor or wholesaler. Basically, they're the middleman who go out and sell these mutual funds. And of course, a dealer is, well, a broker-dealer, right? When they act as a dealer, they're trading for their own accounts. And as a broker, acting as a broker, they're acting as an agency capacity, matching up a buyer and a seller. Okay, Alexis is 4 in a row. Pretty impressive. Short sellers have A, limited profit potential and limited profit and loss potential. B, limited profit potential and an unlimited loss potential. C, unlimited profit and loss potential. Or D, unlimited profit potential and limited loss potential. Right, you are. Yes. Short sellers, they sell the stock short. They borrow shares and sell them with the intention to wait till they fall in price, buy them back later to replace what they borrowed and keep the difference. Well, the lower it goes, the more money they make, but right, because they can buy it back cheaper, but it can't go below 0. So there is limited profit potential. But if it goes up instead of down, then they have to replace what they borrowed at higher prices. And once again, it keeps going higher, they lose more money because they have to pay more money for it. And there's no ceiling how high a price can go. So yes, unlimited loss potential, at least in theory. All right, Karina moves up, and Alexis maintains a commanding lead and is on fire with 5. Which of the following orders can be used to close a short position in CDC stock that consists of 1,000 shares? A, write 10 CDC call options. 2, sell 1,000 shares of CDT. 3, C, buy 1,000 shares of CDT. D, buy 10 CDD call options. If somebody sold short CDC stock of 1,000 shares, they can, right, that would be an opening sale. They get out from under that short position, out from that liability by buying 100 shares of CDT back, right? That we buy to close. So yes, that's the best choice. Selling another 1,000 shares of CDT? No, remember they already sold it short, right? A short position means they already sold it. Selling another 1,000 shares wouldn't close out that short position, right? Wouldn't zero them out. Alexis is 6 in a row. Hey, not bad. The trade would be placed in a discretionary account if the registered representative chooses which of the following. 1, the time of the execution of the trade. 2, which security to buy. 3, how much is the security to buy. 4, at what price to execute the trade. Is it A, 2 and 4, B, 2 and 3, C, 1 and 2, or D, 1 and 4? 2 and 3, exactly. Let me bring that graphic up again. It would be discretionary if the customer allows the rep to choose what security to buy or how much of it to buy. That would be discretionary. We're letting them use their judgment. Time and price is not considered discretionary. It does not have to be in writing. Okay, Karina moving up, and Alexis, a mighty commanding lead. Let's check our next question. Which of the following transactions has the most risk? A, selling short. B, short against the box. C, buy to open. D, selling to close. Awesome. Selling short has the most risk because if they borrow the shares and sell them, they have to replace what they borrowed. But if the price goes up instead of down, they have to replace it at higher prices, not lower prices. The higher it goes, the more money they lose, and there's no limit to how high it can go. Short against the box means they actually own the stock and then sell the stock short. Now, that's basically done to kind of lock in their sell price now and defer the actual gains until later. People used to use that to kind of play a tax game, but they can't do that anymore. Buying to open, well, of course, that does have risk. Buying an investment, but the most you can lose is the amount of your investment. Whereas selling short, potentially unlimited risk. Selling to close means you're getting out of something, you're selling something you already bought. So by doing so, of course, you've eliminated your risk. Okay, or already taken your risk. All right, Karina's 4 in a row, and Alexis still maintains a pretty good lead here. An investor with no existing positions in MMS stock sells 100 shares. This is A, a short bullish position, B, a long bullish position, C, a long bearish position, D, a short bearish position. Awesome. Right. They don't have a position in MMS stock now, and then they sell 100 shares. Since they already have MMS and sell it, that is a short sale. And selling short is bearish because they expect the price to go down. They'll make money if it goes down. Good. Yeah, no, okay, remember, short is bearish, long is bullish, right? Long means to own, and if you own it, because you expect it to go up. Karina moves up, and 5 in a row. Wow. Selling long is equivalent to which of the following? A, selling to close. B, selling short. C, selling to open, then buying to close. D, selling to open. Nice one. Yes, selling long, right? Long means you own it, right? So selling long means selling something you own, and that means you're getting out of an investment, or that's a closing sale. Yes, it is selling to close, exactly. All right, Selling to open, then buying to close. No, there's just one transaction here, okay? Yeah, it's just one transaction. Sell to open, then buy to close. That would be a short sale and then covering the short position. Okay. All right, Alexis, get some more points. And next one. Which of the following transactions has the least risk? A, selling to open. B, selling short. C, short against the box. D, buying to open. Afraid there was only one choice here. Buying to open can be a risky strategy because if you buy something, there's always the chance that it goes down in value. And the worst case scenario, of course, is it becomes worthless and you lost everything you had. Short against the box, remember that's someone owns the stock and then sells the stock short. They call it short against the box because people traditionally kept their paper stock certificates in a safety deposit box. So they're saying, okay, I want to sell the stock short, and then I'll deliver the stock that I own from my safety deposit box. And they use that to lock the price. Because if the stock goes up, right, they'll make money on the stock that they own, but they lose on the stock that they owe. And if the stock goes down, they make money on the stock that they owe, but they lose on the stock that they own. So they just basically cancel each other out, right? It basically becomes flat. So yeah, so in short against the box, that basically stops any kind of risk. I saw someone had a virtual hand raised. We're having trouble understanding opening and closing. Okay. Well, when someone starts a new investment, when they create a new investment in their portfolio, that's an opening transaction. When they get out of that investment, that's a closing transaction. The obvious thing, of course, is you buy an investment and sell it later, hopefully for a profit. So it would be an opening buy or buy to open, and then you get out by selling to close or closing sale. But on the other hand, sometimes the first thing someone does is sell something. We write selling a stock short or writing a call option or a put option. Their first transaction is a sale. So that would be an opening sale, which creates again a liability to them. They get out from under that liability by buying that security back again, right? If they sold the stock short, they buy it back again, hopefully at a lower price and get to keep the difference. Or they write an option contract, which remember when someone sells an option, they're exposed to a lot of risk because they have to do what the contract says. Well, they get out from under that obligation by buying the contract back again, basically canceling it out. Okay, so that would be a closing purchase. Thanks, Karina. Okay. Next question. Selling shares not yet borrowed or located to be borrowed is A, known as closing a short sale with a purchase. B, known as closing a position with a sale and is prohibited. C, is known as a short sale and is prohibited. D, known as a naked short sale and is prohibited. Excellent. Yes. Selling shares not borrowed or located to be borrowed. Right. That's selling something basically with the representation that you own it and can deliver it. It's a regulation called Regulation SHO for short sales. That regulation says to sell a stock short, they must borrow the shares or find them to be borrowed. If they can't find them to be borrowed, you can't do the short sale. Selling them anyway, or placing an order to sell long, representing that you own it, but you really don't, that's a violation. Okay, yeah, that's a big time. That's a market manipulation, and yeah, you can get busted for that. Okay, let's see. Oh, Kimberly's moved up. Let's try our next one. Your customer opens this position at 45 and closes it later at 47. This represents A, a 40% gain, D, a 2-point gain, C, a 2-point loss, or D, a 2-point gain or loss. That's the thing here, right? It said it opened at 45 and closed it at 47, but didn't specify whether it was an opening sale with a closing purchase or an opening purchase with a closing sale. Didn't say one way or the other. So therefore, we just from that information alone, we can't be 100% certain. Now, because we tend to think that if they opened it at 45, they bought it at 45 and sold it at 47, right? Opening, purchase, closing, sale, that would have made a 2-point gain. But nevertheless, it doesn't specifically say that because they could have sold it short at 45 with an opening sale and bought it back again, a closing purchase at 47, and they would have lost 2 points, lost $2 a share. So yeah, this particular one doesn't tell us one way or the other. This one's a little tricky, but that's the importance of reading the questions carefully. You got to watch out for their tricks. Next question. An investor who has a short position in 500 shares of JKH common stock would eliminate that position by A. Entering a closing purchase order for 500 shares of JKH. B. Entering a closing sale order for 500 shares of JJK. C. Entering a closing purchase order for 500 shares of ABC. Or D. Entering an opening purchase order for 500 shares of JKH. Great, since we did a good job there of, again, not falling for their tricks. The customer had a short position. They sold to open 500 shares. They would buy to close 500 shares of JKH. Notice that the other two of the four here, the blue and the yellow, are for different stocks. All right, that'd be totally different, totally irrelevant transaction, right? Or at least not related to each other. An opening purchase? No, they already had an opening sale. They got to finish it off with a closing purchase. Nicely done. Good, okay. Let's try the next one. All right, last question is, all the following are bullish positions except A, long calls, B, long stock, C, short stock, or D, long warrants. Good show, right? Buy long means to own. You buy call options if you think it's going to go up. You buy stock if you think it's going to go up. You can buy warrants if you think it's going to go up. But selling a stock short is a bearish position, right? Selling the stock that you don't have with the intention of waiting to fall in price and buying it back later. That's a bearish strategy. Okay. Now, a warrant, remember, is a derivative instrument, right? Which lets someone buy the stock at a fixed price. So still buying the stock lets her lock in their buy price. All right, let's see who's on the board. In third place, bronze medalist is Karina. In second place, silver medalist is Alicia. And in first place, gold medal and Olympic champion, Alexis. Commanding lead. All right. Okay. Good job. Okay, pause here. It worked. Okay. That was impressive. They had a really good lead here, so nicely done. You've been practicing. Okay. All right, let's go ahead and close this out here. Let me go ahead and pause this for a bit. Okay, now we're going to go over an overview of the option strategy. So we're going to have the chance to review here. Okay, so again, this option strategy summary is a 2x2 grid, and I'm going to suggest draw that on your scratch paper or the marker board they give you at the test center. Just draw that right in this 4 quadrants. Just remember 2 things. First off, you got buy, calls and puts in the rows, buy and sell in the columns, or long or short in the columns. That's in the upper left corner. Oh, kind of came back in. Okay. In the upper left corner, buy calls is bullish. So draw an up arrow in the upper left corner. And then everything else is opposite. If buy calls is bullish, okay, then buy puts is bearish. Okay, oh, this is interesting how they set this up. Why do they do this way? Yeah, true. Buy puts and sell calls are bearish. It's just I don't usually see this in this format. All right, so instead, calls and puts are in the rows, buys and sells are in the columns. They did things a little differently here. So okay, but again, why do you buy calls? You buy the call or long call option to buy the stock at a fixed price. You buy to lock in your buy price now because you expect the price to go up later. Or if you have a short stock, if you sold the stock short, you can buy a call option so that to protect your short stock position in case it goes up, and then you can buy it back at a fixed price and limit your losses that way. Buying put options. People buy put options if they think the price is going to go down. That's why they lock in their sell price now. So they can, if it does go down, they buy it later when it's cheaper and then sell the stock to someone else or put it to someone else at the strike price and make a profit. Or if they already own the stock, they can buy a put option to lock in their sell price and get out of that stock or close that position, okay, sell to close at a fixed price and limit their losses that way. All right, then why do people sell call options? To sell a call or be short a call option? Well, they have the opposite opinion of the person who buys the call option. The person who buys it thinks it's going to go up. So the person who sold them says, no way. And they figure that the option will just expire and they get to keep the premium and not have to do anything. Okay, easy money, but it can be a hard way to make easy money because they have unlimited loss potential. Oh, hang on a second. Let me just fix the, let me, okay, no, it doesn't seem to let me do it. Okay. I was just hoping to fix the, just hoping to fix the screen recording here. Okay. And of course, selling a put option, right? Well, someone who buys the put thinks it's going to go down, and the person who sells them says, nope, no way. And they're all happy to take their money because they figure the option will not be exercised and they just get to keep the premium. But of course, they can also use it as a partial hedge against a position to collect some income by selling the option. Okay, hedging strategies, like we said here, protective and income strategies. So hedging strategies to protect gains, okay, or to prevent losses. So to protect the long sale, so someone owns 100 shares of stock or 1,000 shares, they can also buy 10 contracts, 10 put options, because it'll let them sell 1,000 shares of stock at the pre-agreed price and either lock in gains that they might have had or protect against losses. In a short sale, we've talked about this, they sell the stock short. They think it's going to go down, but in case it goes up instead of down, they buy call options so they can buy the stock back at a fixed price in case it goes up too far and limit their losses that way. Covered call writing. Someone owns the stock and they sell call options against it because they're collecting income from that. But in such, they did pre-agree that they'd let someone else buy their stock from them at this fixed price, and it does limit their potential gain. But of course, in exchange, they receive some cash flow for it. That's what they got paid for. And covered put writing, which is not very common to see, when someone sells the stock short, okay, and then writes or sells a put option, giving someone else the right to sell their stock to them at a fixed price, and they're just basically getting paid to buy the stock from someone else. They were going to buy the stock back eventually anyway. And that's our summary on options and everything we need to know about them. Okay, so before we leave the options part of it, is there any part here that you need to know more about? Anything that's still a little unclear? As always, if you keep practicing with them, you get to the point where it just makes sense. It falls into place. You just got to practice a whole bunch of times. So take as many practice questions as you possibly can. Use those T-charts. They're super helpful. Did I share this with you about how I wrote things down on a piece of paper? I'm not remember if I told you about that or not. If I use a little sticky note or something. Does anybody remember me telling that?
Not about this one specifically.
Okay. So here's the thing, right? Options are contracts, right? Between two people. Now, when I was studying for my test, I always knew that people can trade options, right? So, and options are a contract. Well, I always heard these stories about, some business deal gets done and they write a contract on the back of a cocktail napkin. And next thing you go, you got a $10 billion business. So you know what? That's what I would do. I would grab a sticky note or some scrap of paper or something, and I would write on it something like, call option. I have the right to buy 100 shares of fill in the blank stock at fill in the blank price by fill in the blank date. That's what a call option is. So if the test question says someone buys a call option, then in my head, okay, I give somebody money, they give me a piece of paper. Now, I'd like to see when this piece of paper is all filled out with the blanks, that it would be profitable for me to use it. If it says I have the right to buy it at 35 and I see that it's worth 40, well, if I could buy something for $35 that's worth $40, I think I'm going to do that, especially out of pay for the privilege. Then I'll take this piece of paper that I bought, go back to the person I bought it from, stick this piece of paper under their nose and say, I'm going to buy the stock from you at the price we agreed. Now that I bought it for them, I can turn around and sell it at $40 and make a profit that way. Now, on the other hand, if I had this piece of paper says I can buy it for 35 and on the expiration date, the stock is 30. Do I want to buy something for $35 that's worth $30? I don't think so. This is no good, okay? And it's on its expiration date. So basically, this is a losing ticket at the racetrack. Tear it and toss it. On the other hand, if the test question says someone sells or writes an option or is short an option, then in my head, somebody gives me cash. I give them a piece of paper. Now, I'd really like it, from my point of view now, if I watch them walk away and tear and toss that piece of paper. Because I gave them the right to buy it at 35 and it's worth 30. They're not going to come back to me and say, right? They're just going to tear up that piece of paper and I'm still holding on to their cash. That's what I'd like to see. But it could happen that it's above $35, so they're going to come back to me with this piece of paper and stick it under my nose and say, I'm going to use my call option and buy it from you at 35 like we agreed. Well, guess what? I got to do what the contract says. I'll have to sell it to them at 35. If I already have ABC stock or whatever stock is, easy enough, I deliver something I already have. That's what makes it covered. If I don't have it, I have to go get it, and that makes it uncovered, and I got to go pay whatever it is now. Whatever it is. Okay, so when I wrote it down on a piece of paper, I imagine handing it off to someone else or they hand it to me. It just helped me go from vague concept to something at least I can see and touch. And it made it more real for me, made it more concrete. After a little while, I didn't need the piece of paper because I just did it so many times, I just got used to it. Okay, so see if that helps you out, all right? If it helps you kind of visualize something. All right, on to our next section now is individual customer accounts and suitability. Okay, so with customer accounts, well, of course, what does it take to open a customer account? What information is required? What information is requested? What sort of what accounts are there available to open? And then when someone opens an account, well, we might make recommendations to that person. We need to know that those recommendations are suitable to the person we recommended to, right? It's the right fit. It's a good fit for them. All right, we're required to make sure that any recommendation is suitable to that person. So with suitability, all the things we've talked about and all the things we read and studied, this is where it's starting to come together. Okay, first off, we have accounts for individuals. So an individual account is account for one person. It's got the one person's name on it. It's the one person's property. Okay, and they can do with that property as they wish. Now, some information is required in opening a new account. The required information is the customer's full legal name, a street address, right? The actual address where they live, right? Not a P.O. box. We can mail to a P.O. box, but we have to have their street address on file. Date of birth, right? That helps them to know, right? Well, they're of legal age. And a social or tax ID number. Now, that's partly to confirm their identity, but also, of course, for the tax reporting to send the 1099s. Okay, we also want to know if they work for another broker-dealer or financial institution, because if they do, certain stipulations apply, right? If they work for another broker-dealer, right, they have to have permission from their employer. Now, we have to alert them that company that one of their employees opened an account here. Okay. Well, by the way, it's not on the slide, but we'd also want to know, are they an officer, director, or 10% shareholder of a publicly traded company? Because if they are, that makes them insiders. And if they're insiders, there's certain stipulations. A question here says, if one works for a fiduciary, does that count? Or are there limitations? Well, it may depend on what the fiduciary is, but the idea is it's another broker-dealer, okay? Now, another financial, like investment advisors are fiduciaries too. I've never heard of anyone saying if you work for a investment advisor that you have to notify your employer or get permission from. I've never heard that happening. In the real world, I'll probably ask your manager, but I've never heard of it. So having said that, since I don't think they'll ask about it, and if they do, I'll probably say no just because it's never come up. Yes, Karina?
This is like in a personal example because I was trying to get Fidelity and log in, like create an account with them, and it was asking those kind of questions on like if I worked under a broker dealer or a financial institution. So I was just wondering, would that qualify myself as that since I do work for under an investment advisor?
Well, as in working for an investment advisor, that might make you a fiduciary. Well, if you handle customer accounts, then that might make you a fiduciary to your customer, right? Always got to look out for your customer's interest first. They would ask. I mean, I can understand if they ask for you work for another financial institution, but I've never heard it specifically said that you have to like notify your employer if you work for an investment advisor. I'm hoping I'm answering your question. I'm not sure if I am. Okay, thanks, Karina. Okay. Also, now the new account form requires the signature of the principal who approved the account. Remember, a principal is a supervisor, and if they're going to make, if the rep will make recommendations, then we're going to need the rep signature also. But according to regulators, a customer signature is not required on an account form. Now that may come as a surprise, figuring don't people have to sign everything? I say, well, at my firm, they had to sign everything. Well, here's the thing, right? The test is about industry regulations, not about your firm's policies. So sometimes you have to put aside policies on which you've been trained to focus on the answers for the test. Under regulations, firms are not, the customer signature is not required on a cash account form, but your employer can require it. Okay, your firm can require it as a policy. We also ask for their citizenship, and also, of course, if they're not a U.S. citizen, we're going to ask for their foreign passport or possibly a green card. Okay, I mentioned before, are they an officer director of a traded company? Now, customer account records have to be kept on file for 6 years. Now, 6 years from when? Well, it's 6 years until they basically close the account and they're not customers anymore. Now, the Patriot Act of 2001, which comes in the wake of September 11, has to also additional other things as well. So we have to independently verify that they are who they say they are, because this is like anti-money laundering. So we have to confirm the customer's name, address, social, and date of birth. And you can do that. Of course, we need an unexpired, government-issued photo ID. Now that can be a driver's license, a passport, DOD, military ID card, state-issued ID. Those will all work. What would not work would be a social security card. Well, why not? It's government issued and you need a social security number. It's because it's not a photo ID. That's why. So firms have to have, as their procedure, right, a customer identification program, CIP. So they have their written procedures on how to verify that they are who they say they are. Now, other ways, by the way, they confirm that they are who they say they are. What if they don't have a driver's license? What if they're opening an account over the phone and they can't see a driver's license? Then what we can do is we can get a referral from another financial institution who has verified someone's ID. Okay, or we can use the databases from the credit bureaus, right? The Experian and TransUnion Equifax. We can use their databases to confirm that they are who they say they are. Those are non-documentary methods, which will be spelled out in a firm's customer identification program. All right, records relating to ID have to be kept for 5 years. All right. Also, when they open an account for somebody, they have to check the list that's provided by the Office of Foreign Asset Control, what's called a Specially Designated Nationals List, SDN. The Specially Designated National List is to financial firms what the no-fly list is to the FAA. So if someone's name or a company name appears on the list, we don't open an account for them. Once they've opened their account, they give us this information, and they're going to update. We're going to refer this, basically get a verification of this information, mail something to them within 30 days of opening the account that says this is the information you told us. Let's confirm information is all correct. Every 3 years, every 36 months, okay, they have to do that again. They're going to send them another message, or send them another letter, and ask them to verify or update the account information. Because after all, things change after a while, right? Maybe their income or net worth has changed, hopefully for the better, okay? and maybe their investment objectives have changed, right? After a period of time, right, they might have a different focus now. Okay, now firms should also use diligence to find accessible customer information, to identify their identity, investment history, investment objectives, and source of funds. So know your customer, right? Because before we can make any recommendations to somebody, we have to know our customer well enough to know that it is suitable to that customer and be prepared to document the reasons why we made a recommendation. Now, if they don't have this information, now remember, there's certain information is required. Name, address, date of birth, and social. That's required. Everything else, things like investment objectives, income, net worth, tax bracket, that's requested information. It's not required. We request it because that will help us determine whether a recommendation is suitable or not. If we don't have that information, they don't have to provide it. But if we don't have it, we cannot make a recommendation to that person because we've got no basis to know if it is suitable or not. Okay. Okay. Now, and by the way, if they don't provide this information, we can't make recommendations. In that case, all orders, right? All transactions must be unsolicited. An unsolicited order is one where the customer calls and says, "This is what I want to trade." As long as the customer picked up the phone first and says, "This is what I want to trade," that's unsolicited, and that's all right. We don't have to worry about it because the customer requested. A solicited transaction is one where we call the customer with a recommendation. So we can't do it. We can't make recommendations if we don't have this information. All right, the anti-money laundering requirements, and firms have to have anti-money laundering efforts, which has to be led by a specific compliance officer. The anti-money laundering, so money laundering, there's 3 phases in the money laundering process. They are placement, that's taking this money that's from illegal activity or sometimes even terrorist financing activity, and putting it into the financial system. Okay? Then there's the layering, which taking this money and moving it around from place to place until it's basically no longer can tell where it came from. And then integration, taking this now laundered money where it's no longer traceable and putting it back into use, whether for legitimate or illegitimate purposes. So placement, layering, integration, PLI is how I remember it. All right. Let me just check here real quick. Okay. I'm going to go a little bit out of order here because any transaction, so firms have to be careful, right, of possible anti-money laundering, and that includes filing a currency transaction report, CTR. So any transactions of $10,000 or add up to $10,000, right, are going to be reported to FinCEN. FinCEN is part of the Treasury Department, is Financial Crimes Enforcement Network. Okay, so it's a reporting agency that's part of the Treasury Department, and any cash transaction of $10,000 or more has to be reported to FinCEN within 15 days. Watch out for structuring. Structuring means that they add up a series that add up to or close to $10,000. Someone brings in $5,000 in the morning and $5,000 in the evening. Are they trying to fly under the radar of the currency transaction report? If so, something looks a little fishy here. Something looks suspicious. So then firms will follow a suspicious activity report. Okay, so the SAR, which comes under the Bank Secrecy Act, which is the Anti-Money Laundering Act, requires broker-dealers and other financial firms too to file suspicious activity reports with FinCEN within 30 days if something just doesn't look right. Well, what just doesn't look right? We just mentioned structuring. Does it seem they're trying to get away with something here without the currency transaction report? Are they seem to be like doing a whole lot of wire transfers out of the country? Are they seem to be unconcerned about fees or costs or risks that people would normally be concerned about? Do they seem reluctant to talk about what their plan is or what they're doing? If something just doesn't look right, fill out the suspicious activities report. Firms must also, as I mentioned, have an anti-money laundering department or the policy headed by a specific compliance officer who create the anti-money laundering procedures. The know your customer procedures to know that they're making, part of it is reasonable recommendations to their customers and their source of income. a risk-based customer identification program, okay, to make sure that they are, again, like they are who they say they are. And also their anti-money programs have to be independently tested. So there has to be a consultant comes in and stress test their anti-money laundering efforts. Okay. Also, of course, we have to train companies' personnel, right? To train the employees on what to look for. What are the suspicious activities to be on the lookout for? Right. Regulation SP, which stands for Statement of Privacy. Firms have to have a privacy policy. And when someone opens the account, they must be given the written privacy policy, which describes what a firm does with someone's information. Okay, how that information is going to be used, including, by the way, how they might share that information, possibly with other firms. Okay, right, for usually for cross marketing. Okay, so we have that as well. Also, they have the ability to about the firm's personally identifiable information, PII. If you work for any kind of financial firm, you probably heard that before. Personally identifiable information is some data, some information about a person that can be attributed to that person, right? Who that specifically is, or in combination with other details, could be that specific person. That would include a person's name, or their address, or their email address, social security, obviously, okay, driver's license numbers, things like that, that could be attributed to a specific individual. So any information that's personal identification like that has to be very careful with how they handle it and how they handle it with non-affiliated third parties. Right. So non-affiliated, right, someone that's not affiliated with the firm, but maybe they're doing some sort of cross-marketing with them. People also have to be known that they're allowed to opt out of information sharing with a non-affiliated third party, opt out of this cross-marketing. But notice it's an opt-out, it's not an opt-in. It also has to be easy to opt out, whether it's check a box on a form, click a mouse, make a phone call. That's it. To ask them to say they have to write a letter to opt out, no, that would be too right. That would be too difficult. That would be onerous for them to do. So it's got to be easy to do it. Okay. For a customer, AML. Sorry, I just saw your note here. AML means anti-money laundering. That's what it means. Anti-money laundering. Regulation also SP also makes a distinction. Let me make sure it's here. It makes a distinction between who is considered a customer and who is considered a consumer. A customer is someone with an ongoing relationship with a financial firm, whereas a consumer, okay, has no ongoing relationship, okay, other than just one time, basically, one and done. So that would be a consumer. So they make that distinction. For a customer, they must be provided the privacy statement, right, and their how you handle customer information has to be given to them when they open the account and every year after that. So they'll get a statement and insert along with their statements. A consumer just gets the one-time document, the privacy statement, but since they're only one and done, basically, no, they don't have to receive one every year. An example of a consumer, for example, the firm I used to work for had a deal with AT&T, a contract with them, because every year AT&T gave each employee 5 shares of AT&T stock, and employees could either choose to hold it or they could choose to sell it. Well, the people who chose to sell it would have basically a one-time account. Get 5 shares of AT&T, sell them, send them a check, and that was it. They'd be consumers, one and done. Now, someone who's the account owner, of course, has full information on the account, and account information cannot be given to anybody else who's not the account owner unless that account owner has given prior written permission for someone else to act on the account owner's behalf with having a power of attorney. Power of attorney means they act as on someone else's behalf, right? In someone else's stead. So an account owner has to have a written form giving someone else power of attorney, giving authorization to act on the customer's behalf to get account information or place trades. Now, there are 2 types of power of attorney. There's limited power of attorney. Limited power of attorney has the ability to get account information and can enter buy and sell orders. But someone with full power of attorney, okay, has all the ability as the account owner themselves. They can get account information, place trades, and either add or withdraw money or securities from the account. Okay. Now, of course, frequently married couples will give each other power of attorney for each other's accounts. But they do have to go through the steps and fill out the forms. And it happened all the time when I worked as a rep. A trustee or a power of attorney, a trustee is someone specifically designated in a trust. Okay, a trust is a kind of legal entity too, who of course has a fiduciary obligation to handle the assets of the trust according to the instructions given by the trust creator or trust grantor, to handle the assets for the beneficiary of that trust. As a fiduciary, putting the beneficiary's interest ahead of their own at all times. A power of attorney, yes, would be for an individual or can be for a joint account too. But yeah, like I said, they usually give each other power of attorney. Now, this happened all the time when I worked as a rep. A man would call in and he wanted to do a trade in his wife's IRA. IRAs are individual accounts, right? And there's no such thing as a joint retirement account. So so it's only her account. And she never filled out the power of attorney form that granted him authority or access to get information. So I'd have to say, I'm sorry, I don't see that you have power of attorney on the account. I can't give you account information or place the trade. I'll mail you the forms you need, but until those forms are in, I can't give you account information. Now they're not going to be happy with you, by the way. Okay, they'll push back on it. All right, but you have to be polite but firm. Now, notice here it says that the power of attorneys are revoked upon the death of the customer. Now, a power of attorney is valid as long as the account owner is alive and has full mental capacity. Should the account owner be incapacitated, a regular power of attorney won't be good anymore. In that case, what we have to have is a durable power of attorney. A durable power of attorney will be in force even if the account owner is incapacitated. Without that, a regular power of attorney, if they're incapacitated, no, it's not good enough. All power of attorneys, of course, are withdrawn upon when the account owner passes away. Now, when a customer gives their registered representative the authority to act on their behalf and place trades on their behalf, that would be giving discretionary authority to the rep. And the discretionary account is one where the customer just basically says, you need what you need to do, take care of business, and you don't have to call me with permission for every trade. You just go ahead and get it done. That would be a discretionary account and has to be a written power of attorney to do so. Okay. All right. Now, if there's not a discretionary account, in order to place a trade, the rep needs at least 3 things from the customer to make a transaction. And we're going to remember them as the 3 A's. The asset, which is the security itself, whatever security they trade in. The action, meaning buy or sell, and the amount, whether it's in shares or dollars. So if the customer provides all 3 of those things, that is not considered a discretionary order and does not have to be in writing. That would say the customer says, buy 200 shares of Altria Corp if you see the stock correct. See, the one thing they would leave out of that is the price. They didn't specify a price. They'll let their rep use their judgment when they think the price is right. They call this the price and time exception, right? Because if the customer provides all 3 A's, but lets the rep use their judgment as to price, it is not considered discretionary, does not need to be in writing. In fact, this is known as a market not held order. It gets that name because the firm, the broker-dealer, is not held to price and time of execution. They're going to let their rep use their judgment when they think the price is right. So they might try and see if they can work and see if get a better price, but if the price gets worse before it gets better, sometimes that might happen. They've got no complaint about it. Okay, just understand sometimes it goes that way. Okay, if the customer lets the rep choose one or more of the 3 A's, that would be known as a discretionary order. Okay, a discretionary account means they get full power of attorney on them. A discretionary order means for this one trade, they'll let their rep use their judgment, what to buy or sell. So a customer says, hey, if you see an interesting looking tech stock, buy it. What do you do with that? There's no specific security, just interesting looking tech stock, whatever that means. Was not a specific action. Not a specific amount. Just the action was there, buy. That would be a discretionary order. That order must be in writing, and the firm has to have it in writing, have it in hand, before they can use any discretion. But email counts. Okay. All right, what the things are not allowed to do in a discretionary account, because that could be a setup for abuse if they're allowed to trade a customer's account, including, something called churning. Right? If you ever heard of the term, churning is described as excessive trading just to make commissions, where it was excessive and unsuitable for the customer, whether it's the size of the recommendation or the frequency of buy and sell recommendations is excessive and unsuitable. I saw a Dilbert cartoon, and Dilbert goes to a financial planner's office, and the planner says, "We turn all your worthless equity into valuable transaction fees." That would be churning the account. Okay, which is of course an unethical business practices. So when the account has a discretionary authority on it, all trades, right, have to be reviewed by a principal, by a supervisor. Now they don't have to prove it ahead of time; they can do so afterwards, but they do have to prove it and review it periodically to look for things like, are you making unsuitable recommendations or unsuitable trades or churning the account? Okay, that has to be looked for. Why can they do it after and not before? That's why there's a 2 business day settlement period. So if there is a problem with it, right, they've got time enough to make a correction. What if you work for a FINRA member firm as an employee, working as a registered representative, can you have an account at another firm? Well, regulators say it's okay. Now, your employer may have a different opinion, and they probably will. In a real life example, but the firm I used to work for would not allow any outside accounts unless it was for a product that my firm didn't offer. Okay, otherwise, no way would they allow it. So before opening another account at another firm, you must make a written request and get prior written approval. Assuming, in the unlikely event that they do allow it, you have to go to that other firm where you open the account and you notify them that you work for another FINRA member. That firm will notify your employer to say you open an account with them. Your employer has the right to be big brother and totally look over your shoulder. They have the right to get duplicate statements and trade confirmations, watching every move you make, okay, to make sure you're not doing things you shouldn't be doing, right? You're not trading on the prohibited list, for example. Now, FINRA says that firms may request duplicate statements and trade confirmations. However, the MSRB, the Municipal Securities Rulemaking Board, that's who oversees the municipal bond industry. They don't say it's on request. They say mandatory. Must receive duplicate statements and trade confirmations. Does this rule apply also to relatives? Yes, to immediate family. Immediate family means everybody except aunts, uncles, cousins, and grandparents, but does include someone who provides more than 25% of their support. This rule does not apply to things like mutual funds or variable contracts or annuities, because as an investor in a mutual fund, you have no control or even influence about what the fund manager might buy or sell. So there's no way that you can try and do anything unethical or try and get around the rules. So it doesn't apply to things like mutual funds. All right, now about suitability and account maintenance. Okay, hang on a second. Let me just see how many slides are left in this section. Okay, not that many. So if you're feeling up to it, I can use a little drink. Let's go ahead and take another break. Okay, let's go ahead and break and return at 22 past the hour. Okay, as always, of course, if you would like to ask a question or request to go back to another slide, just let me know and I'll reply accordingly. All right, and that I'll see you in a few. All right, welcome back from break, and let's continue our section here, which is on suitability and account maintenance. All right, so let's go over this. Okay, so suitability information. What information is requested to get information so that we know we can make suitable recommendations? These are things like, well, we can ask somebody's age. Now, the reason we ask someone's age is because that can be a clue as to their risk tolerance. Okay, right? Which also goes along with time horizon. See, someone who's presumably older is probably closer to their goals, especially if it's retirement goals. And the closer they are to their goals, right, they want to play things a little bit safer, right? And as older people, right, want to make sure that they're more investing for their income and probably have a lower risk tolerance. Someone who's younger, or at least has a longer time horizon, can afford to be more aggressive. In the long run, they're likelier to outperform. And there's time enough to recover if there's a market downturn. If they're closer to their goals, there may not be time to recover after that. Liquidity needs, right? How easy do they cash? Do they have things like like an emergency fund, for example? This is one of the biggest ones. Risk tolerance. How much risk are they able or willing to take? How much can they stand the ups and downs, both financially or psychologically? How would they react if the market's down or their investments are down 10 or 20%? Would they panic and sell everything? Would they double down and buy more? Would they ride it out? These are things going to let us know, because if someone has a low risk tolerance, right, they're conservative or risk adverse investors, we can't put them in a situation where they might face investment risk. In fact, for some people, the thought of losing money in investments is so distressing, we couldn't put them in a risky situation. Current and future financial needs is expected. Oh, tax status. What tax bracket do they fall in? This can help us determine if tax advantage investments like municipal bonds or traditional IRAs, would they be a benefit or not? And their experience with investments. Do they understand the risk as well as potential return? Now, again, this is requested information, not required, but if they don't have it, we can't make recommendations because we don't know if it's suitable to that person or not. The closest thing you can come to making a recommendation is a money market fund, because that's just designed to be a short-term parking place until they make up their mind about what they want to invest in. Before making recommendations, registered reps are expected to do their due diligence on 3 levels of suitability. Now, this is for retail clients, right, which means the general public. Yeah, so what we call the general, they call them retail investors. You and I are retail customers or individual investors. We invest our own money for our own accounts, as opposed to institutional investors, right, who invest large amounts of money either for their own accounts or for their clients' accounts. Regulators figure that institutions are professionals and they can take care of themselves. They want to make sure that retail customers, the general public, who may not be too terribly sophisticated, aren't being manipulated, taken advantage of, being all overrun with industry jargon that they don't get. And they rely on their financial professional, right, for their recommendations, right? They trust their judgment on them. We want to make sure that trust is well placed. Now, by the way, if it's not an institutional customer, it's not a financial institution, then it must be retail. So you might see the term non-institutional, right, as to mean retail, right? That means the same thing. So the first level is called reasonable basis suitability. That means before recommending it, they have to determine if this is suitable for at least some investors. Now, it doesn't have to be suitable for everybody. In fact, I'm sure nothing is suitable for absolutely everybody, but it's got to be suitable for at least somebody. Right? It's got to have some investment merit, and they're expected to understand the benefits and the risks of that investment before recommending it. Now, you have to tell this to people? Yes, you do. Because time was, they would just basically call every name in the phone book and pitch some product without even knowing what they were pitching. Okay, all right. All right, once they've done reasonable basis suitability, next level is customer specific suitability. Now you have to know your customer well enough to know if this investment product is suitable to that individual. Does it meet their needs? Is it within their risk tolerance? Is it the right fit? And then the next level is quantitative suitability. Well, quantities means numbers. So that's the size of a recommendation or the frequency of buy and sell recommendations is not excessive and unsuitable to that person. And what do they call it? When it is excessive, churning, right? Another word for that is twisting. I rarely see it called twisting, but I have seen it, so I'll mention it. How do you know if it's excessive or unsuitable? Well, that's why we have supervisors or principals to make that determination. But figure this, most people are buy and hold investors. So for them, the level of churning is probably a low threshold. Right. Now, some people are day traders, right? So they're buying and selling already 3 times before breakfast. Their level of churning is probably unreachable. Okay, but that's why we have their suit, right? And so therefore, right, that level, right, it can be different for different people. So what might this look like? Let's say you've asked me, says, hey, I'd like to go out to eat tonight. Can you recommend a place for me to go? And I say you should go to Joe's Crab Shack. Great place for dinner. You'll love Joe's Crab Shack. Now, does Joe's Crab Shack meet reasonable basis suitability? Is it a suitable restaurant for at least some diners? Well, I'd say yes, right? People go to Joe's Crab Shack. There's cars in the parking lot. So I think we passed the reasonable suitability test. But what if I recommend Joe's Crab Shack, but you are allergic to shellfish? In which case we have just failed the customer specific suitability test. And if I say you should go to Joe's Crab Shack for breakfast, lunch, and dinner every day of the week for the next 3 weeks, it's probably because I own shares of Joe's Crab Shack. I think we have just failed the quantitative suitability test. One of the new regulations, this came around in 2020, is called Regulation Best Interest, or Reg BI. So again, this makes broker-dealers always put their customers' interest first, right, ahead of their own, right, exceeding the suitability standard. See, previously, broker-dealers had a suitability standard. Investment advisors had a fiduciary standard, right, which was the next level up, right, always as putting their customers' interest ahead of their own. See, with a suitability standard, a rep could say, should I recommend the ABC balance fund, which pays me 3% commission, or should I recommend the XYZ balance fund, which pays me a 4% commission? I recommend the XYZ fund. Okay, so they're suitable, it would be suitable to that person, but as you see, it's not entirely putting their customers' interest first, because after all, who has to pay those fees, right? Those for that commission ultimately comes from the customers. So as a fiduciary, right, best interest, they'd have to recommend the ABC fund because it is the customer who ultimately pays that fees and got to put their customer's interest first. This applies to, again, a natural person. That means an individual, right? We call what we would say a person, we mean a human being, or their representative, like a power of attorney or someone acting on their behalf. It does not apply to a legal person, which would mean like a corporation, some sort of legal entity. Okay. And it most by someone who gets a recommendation for the broker dealer and their recommendations for their personal investments. So it becomes two recommendations. Regulation BI has 4 obligations for broker dealers. The disclosure obligation, disclose fees, services, and stuff like that. The care obligation, saying they're supposed to do reasonable basis, customer specific and quantitative suitability. They're supposed to do their due diligence. Any conflict of interest obligation, right? If there is a conflict of interest, first off, work to eliminate or reduce that conflict, and to disclose any conflicts of conflict of interest. I think you'll find that is a good general rule. If there's a potential for a conflict of interest, it needs to be disclosed. And as long as it's disclosed and customers or people can make informed decisions, regulators seem to be okay with it. It's when they hide information, regulators have a problem. And of course, there's the compliance obligation to be in compliance with the broker-dealer's policy, and of course, local, state and federal laws and FINRA requirements. Part of regulation best interest is another form for customers called Form CRS, which was Customer Relationship Summary. So the Form CRS is a 2-page document that basically describes in question and answer format the nature of the relationship between a customer and the firm. So in the Q&A format and make it easy to read. So the questions like, what are your responsibilities to me as a broker-dealer or as an investment advisor? How are your associates compensated? Things like that, okay? So it's going to include things like costs and fees, conflict of interest, as it says here, standards of conflict, disciplinary history. So there'll be also a link to BrokerCheck. BrokerCheck is that service that FINRA provides. It's a database that people can look up information about a broker-dealer firm or about the registered representatives. And that would include what the licenses they have, what states they're registered in, their industry employment for the last 10 years, and any disciplinary record is going to be there too. So they can look you up. And if you've been censured by FINRA or someone, yeah, it's going to show up on BrokerCheck. Okay. I looked myself up on BrokerCheck, by the way, and I'm happy to say I've got a good, clean record. CRS, right, is Customer Relationship Summary. All right, and it says Q&A format. So you might never check a look at it. Look at the firm like I don't know, Ameritrade or someone, or who else might be Wells Fargo Securities. Check them out. See what their Form CRS looks like. I'm sure you can download a PDF. All right, customers place orders. So okay, you kind of have to do things still the old-fashioned way with customer orders. You can call them on the phone, or you can go in person to place orders, but you cannot place orders by text, fax, email, voicemail, anything like that. Can't verify their identity that way. Okay. Now, of course, they can place their trades online now because they log into their account with a password protection. Okay. Whenever one executed, the customer is going to receive a confirmation of that trade. Confirmation is a 1-sheet document that's got all the details of that transaction. The date of the trade, what security was, how many shares, if it was bonds, what was the face amount of bonds, if it was options, was how many contracts, whether it was a buy or sell order or sell short, what the price was executed. Did the firm act as a principal or as an agent on the transaction, as a dealer or as a broker on that trade? That's going to be in there. What was the total amount? Any fees or taxes that would have been in? Anyway, all the details of the trade. The confirmation kind of acts like someone's receipt. People don't usually get paper stock certificates with their name on it anymore. So what record do they have that the trade was made? The confirmation. Okay, so like if you bought a stereo and you have to return it, you want to see a receipt. Well, use the receipt. So keep the confirmations for your records. What if there was an error on the confirmation? If the confirmation itself was wrong, then they have to, of course, correct the confirmation. If the trade was wrong, they made an error in the trade, then the firm is responsible for it. So they have to fix that trade, and if it ends up being a loss as a result, the firm has to absorb that loss. Okay. If the error was the confirmation, let's say they say you bought the stock at $25.10, but the actual execution was $25.12. There was a typo on the confirmation form. The real trade was $25.12. They actually got it $25.12. All right, statements. Okay, customers also receive periodic statements, which is a record of their account, which will include, of course, the value of the account as of the day the statement was generated, the list of all the investments in the account and each individual investment's value as of that day, and also any transactions in the account since the last statement was generated, the account history. Any buy, sell, deposit, withdrawal, interest received, interest paid, dividends, all of them have to be on by their date, right, in chronological order. Statements must be generated and sent on a quarterly basis, minimum quarterly basis, or monthly in any if the account has activity. And activity really means anything. Okay, even making interest on a money market fund is activity. So it's quarterly for inactive accounts and monthly for active accounts. There is one rule though, since there's not a mention on the slide. Okay, accounts holding penny stocks, right, must generate a statement monthly. Now remember what a penny stock is. Right? The definition of a penny stock is a stock that's unlisted, means it doesn't trade on a stock exchange, probably doesn't qualify for it. So it's trading the over-the-counter market, the dealer market, that's less than $5 a share. Right? Now we have to have monthly statements on that because, first off, it's a very thin market for one thing. They tend to do not trade a whole lot, and since they trade a lot of shares at one time, because you can buy a lot of shares for such a small amount, even a small trade can move the price, even a single trade. So, even a small change in the price is a large percentage of the value. So we have to keep them up to date on a regular basis. Oops, I went too far here. Okay. All right. People will get their confirmations in the mail. Yes, they can have them emailed now, but the customer can request a mail hold for up to 3 months. So if they're traveling or something, they can request a 3-month hold on their mail. If they want to hold longer than 3 months, they must make a written request, and there must be a substantial reason for making the request. Convenience is not a substantial reason. In case of a business disruptions, firms have to have a business continuity plan, which means what's their backup plan in case, well, business is interrupted. Like what if there's a blackout, power failure? What if there's a fire? What if there's a flood? Right? What if there's I don't know, the streets are flooded? What if there's let's see what else. What if there's I don't know, a tornado, a hurricane, a tsunami, a meteor strike, alien invasion, zombie apocalypse, Death Star. All right, how are they going to pick up, right? How will they pick up business in case of a calamity like that, right? In case of that. So their business continuity plan, which people can request or download, it will describe, well, what were the alternate locations they need to set up if their regular offices are not accessible. What happens if some key personnel should be incapacitated or pass away? Who will step in for them on an interim basis? Okay. All right. Okay, so they do have to have summarized disclosure that's made available to customers, and customers request this. They don't have to give a copy to the SEC, their business continuity plan, but FINRA does have to have the names and numbers of 2 principals at the firm. All right, accounts of former broker-dealer. So broker-dealer retires or gets another job or leaves the firm or whatever it is. Well, what about that person's customers? Okay. Well, they will be allocated to another rep at the firm, right? Because it's really the firm's customers. So they're going to be given to another rep, and then someone else is basically going to help manage their accounts now or take over for them. But what if the person says, "Hey, I don't like you. I want to work with the guy I was working with." So in that case, they might want to request, they might transfer the accounts to another firm. If you transfer accounts to another firm, you fill out a transfer initiation request form, TIF, transfer initiation form, and you always go to the place where it's going to fill out their documents. Let me see if there's a mention here. Hang on a second, because no, I don't see it here. So let me go ahead and cover this. Okay. FINRA requires a system called the ACATS system. ACATS, which stands for Automated Customer Account Transfer Service. Okay, basically it's an electronic transfer. So you fill out the form where it's going to. That firm will go to the other firm called the carrying firm, right? Because they're carrying the customer's investments currently. And that firm will then has 1 business day to validate the positions. One business day to validate the positions or validate the transfer. Means it says the assets that are requested are in fact in the account and are available to transfer, or to take exception, meaning to indicate that they can't do the transfer. Maybe the assets they're requesting aren't there, or it's proprietary mutual funds or limited partnership shares, something that can't transfer. Once it's validated, then they have 3 business days to complete the transfer. So that ACAS system requires them to do so in a rather short period of time, because if they didn't have that system and weren't required to use it, firms would drag their feet on transferring a customer's assets to a competitor. Proxy materials. Okay, so a proxy is basically an absentee ballot, right? If you're a shareholder in a company, you have voting rights, so you can vote on certain things, right? So like if there's a vacancy on the board of directors, or things like mergers and acquisitions, or if they want to issue new shares of stock or something, things that would affect the business structure like that and their equity. It comes for a shareholder vote. Now the vote is done at the annual shareholder meeting, but not everybody can make it to the meeting. So the proxy is like this absentee ballot. So people get stuff in the mail, right? I get them in the mail every once in a while, right? A chance to fill out basically a form to fill out. They'll tell you all the things there are to vote on, and I can check the box that says for, against, or abstain, put it back in the envelope, mail it in, and then my vote will be counted at the annual meeting. Okay, so these are the mentioned things that can come up for a vote. Okay, the board of directors, the company's accountant, authorization, new securities. Like what if they want to issue like convertible bonds or something? Well, if people start converting their bonds, they're going to issue more shares of stock, which dilutes, right, the ownership interest of each existing shareholder. So shareholders got to approve that. Okay, other things that has shareholder resolutions. Maybe some shareholders want to make a resolution to the company. They want something to be done in the company, so comes up for a shareholder vote. Okay, so all those things are as a voting structure. Now, let me see if there's mention here. No, there isn't. So there is a voting structure. So in the company's bylaws, right, the corporate charter, it can indicate 2 types of voting structures. Statutory voting. It helps if I can spell. Statutory voting. Okay, and cumulative voting. Okay, so there'd be one of these 2 voting structures. In statutory voting, all votes must be cast equally. How many votes does somebody get? Right, so people get votes, right? They can vote the number, okay, is number of shares. So you get 1 vote for every share that you own, times the number of vacancies on the board of directors or things to vote on. Okay, so board of director positions. You remember that as shares times shares. Okay, the number of shares you own times the number of vacancies on the board of directors. So if there are 3 board member seats open for election, if somebody owns 100 shares of stock, they get 100 votes for each one of those seats. So that's a total of 300 votes. In a statutory voting structure, all the votes have to be cast equally for each of the things to vote on, or each of the vacancies on the board of directors. So they have to vote 100 by 100 by 100. Right? Vote for or against or abstain. This voting structure, by the way, benefits the large investor, because the more shares you own, the more votes you get, and therefore it's more likely that you'll get your way. You own 100 shares, but I own 1,000. I outvote you 10 to 1. But there's a mutual fund that owns 1,000,000 shares. Well, we both just got outvoted big time, didn't we? Okay. Now, cumulative voting, in a cumulative voting structure, they can accumulate or stack their votes any way they wish. So they don't have to vote them all equally. In fact, if they want to cast all their votes for one board member candidate and none for the other two, they could do 300 for one of them by 0 by 0. Now, this voting structure benefits small investors, because if enough small investors cast their votes the same way, they could potentially outvote the large investor. Okay. All right. Those are the voting structures that you might see. All right. Now, one of the things that FINRA is concerned with is about the, well, as they say, financial exploitation of senior citizens. First off, reps are make sure that they understand the products that are being offered and recommended, and understand that for seniors, right? And the definition, by the way, is age 65 or more. May have their own certain different needs, right? As retirees, they're probably more investing for income and have a low risk tolerance, right? They need their investments to be working for them currently, not to grow later on. So there are certain recommendations that if they're made, they're gonna raise an eyebrow, okay, with your compliance department. All right, they're not necessarily bad, right? If you know your customer well enough, but certainly they should be of a concern. For example, recommending things like variable annuities or equity index annuities. All right, annuities are contracts with a life insurance company. They guarantee a lifetime income. In a fixed annuity, they get a steady payment and they get a rate of return on their deposit, right? That's guaranteed by the insurance company. Very safe and stable. Variable annuity, however, that means the policy owner picks the investments, and all the investment risk is on the policy owner now. Well, if people are being invested, right, they can be invested in stocks or bonds or a mix of both. Well, investments need time to grow. So for someone who's in or close to retirement, they might be better off with the certainty, right, of a fixed annuity rather than the less certainty about a variable annuity, especially if they have a shorter period of time. Recommending limited partnerships or direct participation programs. Okay, DPPs, direct participation programs, because those tend to be, there's highly illiquid investments. They're very difficult to sell. They're almost impossible to sell. So if somebody needs cash or might need the cash, this is not a good thing for them, right? And it takes also some time. So recommending variable life insurance, again, because the policy owner picks the investments in this life insurance policy, as opposed to getting a fixed rate of return from the insurance company. Recommending structured products, which can be hard to sell, very illiquid, and are rather complicated, or collateralized debt obligations, recommending that, this is never the right answer, by the way. If the answer choice says you should recommend that they get a second mortgage on the house to get funds for investments, that is never the right answer. First off, they have to pay interest on that loan, which could eat up and even more than eat up any income they get from that investments. And besides, if those investments go bust, not only have they lost their investments, but they lost their house too. Using retirement funds for risky investments. Now, again, it can be different for each individual person, as long as you know that stuff, right? You can recommend this stuff to Warren Buffett, for example. Okay, right? He's over age 65, right? But he's wealthy and sophisticated. So if they're wealthy and sophisticated, they can do so. Okay, also using unofficial certifications or bogus designations, like certified senior advisor, because there's no such thing as a certified senior advisor or certified senior investment specialist. Okay, certified financial planner, yes. There's a certification board for that, but nothing like that. That's just bogus. Using high pressure free lunch seminars. Okay, FINRA doesn't like that either. No problem. Free lunch seminars are okay. In fact, I've been to a number of free lunch seminars. I get a postcard in the mail sometimes that says we'll take you for lunch at Maggiano's. It's pretty hard to turn down lunch at Maggiano's. Okay, so I've gone to a number of free lunch seminars just to go eat lunch. Okay, no, right, but their problem is high pressure free lunch seminars. sit down at their table with them, goes, hey, look, we just bought you an expensive lunch here. The least you could do is set up an appointment with us. Okay, that's the high pressure stuff. Also, train employees to look out for, I wish there were a more polite way to put this, but diminished mental capacity. We maybe have customers who are suffering under the effects of dementia or Alzheimer's. Okay, first they called it concerns about financial exploitation of senior citizens, but then began to realize it's not necessarily seniors who may have some physical or mental impairment that makes it difficult for them to look out for their own best interests. So now they expand to financial exploitation of specified adults. That's anyone who might have some sort of physical or mental impairment that makes it hard for them to invest in. So what happens if a firm, okay, a rep noticed that their customer seems to be out of it, let's say. Okay. So if so, you must notify your employer, your manager, or your compliance officer, and address that, right? Escalate that right away, and have a designated individual to whom to do so. And we should also have a designated a trusted contact person. We make our best effort to receive a trusted contact person, a family member, a friend, a lawyer, an accountant, someone we can call and talk to in case of whatever. Okay, if they need to do so. Unless, of course, it's this trusted contact person that we're concerned about, who may be committing this financial exploitation. All right, if a firm suspects there's some financial exploitation, all right, some fraudulent on the account, the firm can put a 15-day hold on the account, all right, if they suspect fraud. If they suspect exploitation as well, they can place an additional hold for another 10 business days. That's a total of 25 days. And if there's a government or law enforcement investigation, then it can be another 30 days. So a total of 55 days. Now this hold only replies to distributions from the account, right? Sending a check from the account. If the account is placed on hold, right, we document, right? This is, after all, extraordinary conditions here. So the firm has to document the reasons why they did so, notify the account owner and the trusted contact person, unless, of course, it was the trusted contact person is the person we're worried about. Okay, and that brings up our section on account information and suitability rules. All right, with that, I think, is there, okay, okay. Let me see what other things to talk about next. Okay, first off, if you haven't had the chance, I've gone in, I've at least as of Sunday, seen what your progress has been in, taking your practice exams, giving you your scores as I've seen them. It's a manual process. I got to go through them each individually. Takes a bit of time to do so. If you find that you seem to be running behind schedule here, well, let me know, okay? I'm still offering to people to a free phone call. You and I, we can discuss any topic you like. If you need help, if you need a little help getting back up to speed, let me know. We'll schedule a time to talk. By the way, a bill at the school also says, they've arranged funding for a tutor. Okay. Now, the tutor that they lined up kind of backed out of it, but I recommended someone that I used to work with. I'm kind of waiting to hear back from him to see if he might be available for tutoring. But if he is, well, he'd be great to talk to. Are you interested in having a tutor, especially if someone else pays for it? I can't be the tutor, by the way, right? Because it would be a conflict. If so, Ashley, shoot me an email. You have my email address, I'm pretty sure. All right. That way I can forward that, right, to Bill Wingard at SEC. All right. Yeses and yeses. Okay, I've got 1, 2, 3, 4 yeses and 1 yes if I can make it work. All right, that's 5. All right, that's really decent. So in addition to me, right, I'm going to say that there's definitely interest in a tutor. I've asked 5 people who said they're interested. So hopefully the person I used to work with, I'm hoping he's available. I emailed him yesterday. I haven't heard back yet. So we'll see see if he's available because he'd be awesome. Okay. If not, I know some other people too. All right, with that, folks, I think I'll send you an email. Yes, please send me. You remember my email, right? Okay, richard.victor@scottsdalecc.edu. Okay. All right, it's in the syllabus, and I've sent you emails before, so I hope you have my return address. Okay. All right. With that, we have a few minutes here. Anything that you want to review, ask about? If anything that we've talked about here, you just need maybe just a little more clarity. Something you're still kind of wondering about, please feel free. Maybe someone else would appreciate if you asked the question too. Maybe they didn't think about it and thought, hey, that's something good to know. All right. So then get caught up on this. Mastery exam 2. Go ahead and get caught up on that one also. Okay. And again, please, if you find there's things that are kind of giving you a hard time, kind of slowing you down a bit, contact me. Okay. I'm a resource for you too. All right. I've got this vested interest in making sure you pass your test. Okay. Well, with that, if we're all good for today, oh, actually, it's 8:55. Actually, I should have let you out of here 10 minutes ago. Come on, anyway. So I'm sorry. I thought I was letting you out early. I'm actually late. All right. We'll see you again on Monday, everybody. Have a great rest of your evening. Have a great weekend. Do enjoy yourselves, and I will see you again soon. Take care of yourselves. Bye bye and bye bonds.